Think you're doing okay with money? Let's see how you compare to the average person. Because when you look at the real numbers behind how people actually earn, spend, and save, things can get pretty shocking. I'm Nischa. I'm a former investment banker turned financial educator. And today I'm breaking down 10 jaw-dropping money stats that reveal what's really going on behind people's finances and what you can learn from it. By the end of this video, you'll see why most people struggle to get ahead and how a few smart but strategic habits can put you miles ahead of the average. Let's start with stat number 1, which is what the average household income really is. The average US household income in 2024 was $121,000. And while that might sound impressive, it doesn't tell us the full story, because that's the mean average, meaning everyone's incomes are added together and divided by the number of households. So the final number can often be distorted by higher earners. In fact, a much more accurate number to go off is the median income, which is where you put all the incomes in a line from smallest to largest and you pick out the one in the middle. And in the US, the median or the middle household earns $83,730. And so the gap tells us that a small number of very high earners are skewing the average upwards, while millions of ordinary households are actually earning far less. It is no wonder 2/3 of Americans say they're living paycheck to paycheck, because when you take out things like taxes, rent or mortgage, healthcare, debt payments, that average income doesn't go as far as you'd think. What about over in the UK? In the UK, the median gross annual earnings for full-time employees in the UK stood at £37,430 last year. But, as you might have guessed, the average largely depends on age. With 18 to 24, that is £24,440 on average, compared to 40 to 49-year-olds, which is $42,796. So with all this information, how much do people actually need to feel comfortable? The truth is, what matters most isn't how your income compares to national averages, but how effectively you manage what you earn. So just start by understanding your after-tax income and building a realistic budget. For example, allocating 65% to needs, 20% to wants, 15% to your future you. I have a completely free budget tracker that encourages you to budget using these allocations. It's completely free. You can use it. It's in the linked below. From there, focus on building an emergency fund, then paying off high interest rate debt and investing consistently to grow wealth over time. I have a video as well on how to optimize your finances and in what order over here. And since the cost of living changes so much based on geographic location, it's essential to measure financial comfort by how far your money goes where you live, not arbitrary national figures. The goal isn't to match an average, but to build stability and freedom within your own financial reality. Stat number 2, which shows you just how dangerous timing the market can really be. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half. And missing the best 30 days would have reduced your returns by an incredible 83%. This shows just how damaging it can be to try and time the market. Nothing else. That is what it shows. Because whilst you've probably heard the phrase, buy low, sell high, it's actually much, much harder to do than you might think. You might think stocks are high today, only to go for them even higher. They might dip, making you think they're low, only for them to dip even further. And as the data shows, the best days often happen right after the worst ones. So for example, in 2020, when markets crashed during the pandemic, some of the biggest gains in history came just weeks later. And so if you panicked and you sold when things looked scary, you very likely missed the rebound that followed. This is why long-term investors always say timing the market beats timing the market. This is such a powerful reminder that the biggest risk isn't the next crash. It's just getting scared out of the market and then missing the recovery. So whether you're investing through a 401k, your ISA, a simple index fund, the smartest strategy for most people is the boring one. Stay invested, stay consistent, let time do the heavy lifting. Stat number 3, according to the National Financial Educators Council, low financial literacy costs the average American over $1,000 a year. And honestly, this makes total sense, because if no one's ever taught you how to manage your money, how are you going to manage your money? It's so easy to miss a credit card payment. It's so easy to overlook better savings accounts or to avoid investing because it's complicated. But the truth is, You don't need to be a financial expert. You don't need to have a finance degree to get ahead. Just learning a few key principles can make an enormous difference. Understanding how interest rate works, how to budget effectively, how to avoid common money traps can literally save or earn you thousands every year. Start small, learn one thing about money each week, watch a video or two and just apply what you learn there and then. Before long, you'll notice a difference in your confidence, in your savings, and in your peace of mind. And if you want a simple way to start, you can always subscribe to this channel. I walk through the basics of building wealth every single Sunday, step by step, in plain English. Stat number 4, these stats show the surprising reality of how many people actually have an emergency fund. 18% of US adults said the largest emergency expense they could handle right now using only savings was under $100, meaning nearly 1 in 5 people would struggle to cover even a small car repair or vet bill without needing to borrow money or sell something. Only 63% of adults said they could pay a $400 emergency expense entirely with cash, savings, or a credit card they'd pay off immediately. And the situation is similar in the UK as well. The average person has around £16,000 in savings, but that figure, again, is heavily skewed by wealthy savers. In reality, 2 in 5 Brits have £1,000 or less set aside, barely enough to get through a month of expenses. This lack of financial cushion, it creates a dangerous cycle because when an unexpected cost hits, you can turn to credit cards or loans, which then ends up eating into future income through repayments and interest. So the best way to break that pattern is to start small and stay consistent. Even saving 20 or 25 a week builds resilience over time. You become the person who can save, the person who can prove to themselves that they can put a portion of their income aside to save. Start with 1 month of your essential living expenses and then build towards 3 to 6 months. It's about creating the breathing room that keeps you secure when life inevitably throws a curveball. Stat number 5, and this one is about retirement. About 33% of private sector employees in the US don't have access to an employer-sponsored retirement plan. That means no 401k, no employer match, no automatic contributions quietly building up in the background. And even among workers who do have a plan, only about half actually contribute to it. The way I see this is that it's one of the biggest gaps in the US financial system because having a workplace plan is one of the most simplest ways to build long-term wealth because it gives you an element of structure and discipline that you don't have when saving for retirement on your own. The hardest part is getting started, especially if your day-to-day living costs are high and you're struggling to even save for an emergency like the people we spoke about earlier. When we then throw the lack of financial education into the mix, it makes me wonder how many people don't actually know how important saving for retirement can be and how much easier a workplace scheme can make it. I wonder if the US could benefit from following in the UK's footsteps here because as you can see in this graph on the screen, the number of private sector workers saving into their workplace pension was declining steadily through the early 2000s in the UK. But what changed that was when the auto-enrollment scheme was introduced in 2012. As you can probably guess by the name, the scheme made employers enroll employees into their workplace pension scheme automatically. Workers can opt out if they want, but most don't. By 2018, therefore, 72% of private sector employees were participating in a workplace pension. And it grew even further to 75% in 2021. And it's not because people suddenly became disciplined or became financially savvy. It's just because the system made saving the default. And since employers have to pay at least 3% of the employees' qualified earnings into the pension, when you opt out, you're effectively turning down free money for a better future. So unless the US removes the friction and makes retirement saving automatic, many Americans are likely to reach retirement age relying on Social Security, which might not be enough to get by. Now, the next one is something that I recently talked about on the Diary of a CEO podcast, and I had so many messages from people afterwards to say that learning this tip or understanding the psychology behind it completely changed their perspective on saving. And so I had to share it today. Stat number 6, realizing how much of an impact saving can make to your financial well-being. Did you know that having as little as $2,000 in emergency savings can make a huge difference to your overall financial health, according to a report by Vanguard? In fact, people with at least $2,000 saved reported a 21% higher level of financial well-being compared to those with no emergency savings at all. And those who had enough to cover 3 to 6 months of expenses saw an additional boost of 13%. On the flip side, people without any emergency savings spent twice as much time worrying about money, even if they have money in investments. And investors without an emergency fund spent around 7 hours a week thinking about and dealing with their finances versus just under 4 hours for those with a small buffer. They're also 4 times more likely to be distracted at work because of financial stress. What I really love about this data is that it shows that money isn't just about numbers in your bank account. It's about the emotional side too. Having money set aside can give you peace of mind and help you avoid sleepless nights, stressing about how you're going to pay your bills or even how you're going to pay for your mortgage. That's why having even a modest cushion of just a couple of $1,000s or whatever currency that applies to you can change so much. You'd need just enough to keep you from falling into debt every time life throws a curveball. Because when you have that buffer, you're not protecting just your bank account, you're protecting your focus. You're protecting your productivity. You're protecting your mental health, as we can see. Stat number 7, and this one is about how many high earners are actually just living paycheck to paycheck. According to PNC's Bank's 2025 Financial Wellness Report, 67% of Americans say they're living paycheck to paycheck. That means millions of people are struggling just to cover their basic expenses. And surprisingly, this includes nearly half of those earning over $100,000 a year. This is just a reminder that financial stress isn't only about how much you earn, but also about how much you spend. Lifestyle inflation, i.e. the tendency to spend more as you earn more, can quietly erode your financial stability. You get a raise, you pick up new clients, and suddenly you feel justified to upgrade your wardrobe, to dine out more, to move to a bigger home. But before long, your higher income is completely absorbed by your higher expenses, leaving you pretty much no better off than you were before. The key to breaking this cycle really is to automate. As soon as you get your paycheck, take a portion of it and put it away into another savings account straight away. Out of sight, out of mind. And then as your pay increases, you don't want to keep that amount that you're automatically putting away the same as well. You also want to increase that in proportion to your increase, if not more. Don't rely on willpower, rely on systems. Stat number 8, nearly 1 in 5 new car buyers, i.e. 19.3%, are paying over $1,000 a month for their car in the US. And the average loan term is almost 70 months with a 7.2% APR. The average amount financed is $42,388 and the average down payment is $6,430. And things aren't looking much better for used car loans, which have an average monthly payment of $559 at 10.9% APR, an average term of 69.7 months. This basically means that whether you buy a new car or a secondhand, you can find yourself locked in almost 6 years of payments for something that's losing value the minute it leaves a dealership. If you want to know the most effective way to buy a car and how you can keep your car costs low, I have a complete video on that. It's linked over here. Stat number 9, the average student loan balance in the US is $42,673, including both federal and private loans. The typical monthly payment is around $503, with repayment terms often stretching 20 years or more. For graduate degree holders, that figure jumps to over $60,000 on average. How does this compare to other parts of the world? In England, the average student debt was £53,000 for those who finished their course in 2024. Although this is higher than the average US debt, the way student loans work in England puts slightly less of a burden on borrowers. Because unlike in the US, where student loans function like traditional debt, the system in England works more like a graduate tax. You can only start making repayments once you earn above a certain income threshold, currently £27,295 per year for most plans. And if your income falls below that or you lose your job, your repayments automatically pause. There's also a time limit. After 30 years, any remaining balance is wiped no matter how much you still own. So while UK graduates technically carry more debt on paper, and these loans can grow significantly as interest is added, the system is set up in a way that protects borrowers a bit more. In contrast, American graduates are expected to pay off their loans in full, often over decades, with no automatic write-off period. That is why so many people in the US are still paying off their student loans well into their 40s and 50s. sometimes long after their own kids have started college. Stat number 10, 7% of the US population are millionaires. And I don't know about you, but I found this really, really surprising. That's around 23.8 million people. That means there's more millionaires than the entire population of Florida. And the US is home to nearly 40% of the world's millionaires, far ahead than any other country. China takes second place with 6.3 million millionaires, followed by France with a 2.9 million. Meanwhile, in the UK, there's 2.62 million millionaires, which is 3.8% of the population. But here's what's really interesting. In the US, the UK, and other parts of the world, being a millionaire may make you more fortunate than more than 90% of the population, but it doesn't always mean you're rich. Because thanks to inflation, rising home prices, and higher living costs, having 1 million in assets doesn't stretch as far as it used to. In fact, surveys show that 1 in 3 millionaires say they still feel like they're living paycheck to paycheck, especially those living in expensive cities like in San Francisco and in New York. So while the number of millionaires keeps growing, the feeling of financial security hasn't necessarily followed. And this is just a reminder that wealth isn't just about how much you earn, it's about how well you manage, grow, and protect what you have. One way you can do that is through investing in the stock market, but another way is to invest in yourself. And on that note, I wanted to introduce the sponsor of today's video, and that is Brilliant. Brilliant takes complex topics and breaks them down so they actually make sense. You learn by doing, not just reading, with thousands of interactive lessons covering everything from maths, data analysis, programming, AI. What I really love about Brilliant is how it helps you build a learning habit in just a few minutes a day. I'm always saying that consistency beats intensity, and Brilliant makes this so easy to stick to. Plus, you can learn on your phone wherever you are, so whether you're waiting for your coffee or you have a few minutes between meetings, you can squeeze in a quick session and actually make progress. It's kind of like a gym for your brain, daily challenges in science, coding, problem solving, and also picking up skills that matter in the real world. So whether you're a student, working professional, or just someone who loves learning new things, Brilliant will have something for you. You can check it out at brilliant.org/Nischa. I've put the link in the description below, or you can scan the QR code on the screen right now. They also are giving our viewers 20% off an annual premium subscription, which gives you unlimited daily access to everything on Brilliant. So that's it. Those are 10 shocking stats. If any of them sound familiar to you, awareness is the first step in changing a situation. And well and truly, knowledge is power. You can always subscribe for more personal finance on this channel at any time. Thank you so much for watching, and see you next week.